Hello and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. Happy New Year, everyone, and welcome to our first episode of 2024. I'm joined today by Taj Sidhu, our Head of Private Credit in Europe. Taj, welcome to the show.
Thank you, Justin.
Why don't you give a little bit of background on yourself and your investing career?
Sure. So I joined Carlyle about 6 years ago to build a private credit business here at the firm. I've spent 20 years investing in private credit, so 14 years before that running a private credit business at another large asset manager, and the 5 years before that in the European leveraged finance market.
Great. So private credit is in the headlines a lot today. Where are you seeing the best opportunities to invest in the European private credit market?
So we focus on what's going on today and really what's been happening for the last 18 months. Private credit in Europe is seeing a lot of the same dynamics that you've seen in the US. So the relative dysfunction or lack of reliability of public credit markets, whether that's the leveraged loan market or the high yield market, has really meant that all forms of borrowers, everything from small, sponsorless or family-owned businesses all the way through to the largest institutional borrowers, are really turning to private credit as their primary source of capital. We don't see that changing in the short to medium term. If I take a step back and we look at what's happened in Europe specifically over a slightly longer period of time and what we expect to happen going forward, Europe post the financial crisis has seen a very significant sort of structural growth in private credit, really replacing more traditional bank lending as they pulled back post regulation introduced around the time of the financial crisis. And if you look forward, we'd expect that to grow at roughly 10% from here. And Europe, again, when you compare it to the US, it's a large, mature market, but it's probably only about a third of the size, I would say. So there's still a lot more room for that market to grow. And look, where Europe differs to the US from in terms of just day-to-day business is that sort of relative lack of maturity, if you like, and some of the inefficiencies that always exist in Europe because of the different geographies, the different markets, means that there are times and periods where relative value is very strong in Europe versus US.
You mentioned non-sponsored lending. What are some of the barriers to investing in that space?
So it really comes down to, I'd say, three key areas. So the first is origination. So unlike lending to private equity firms or sponsored borrowers, as we call it, the route to market is very different. So when you're dealing with private equity firms, you want to originate that type of deal flow. You talk to your handful of private equity firms, whether it's 20 or 30 firms, and your origination is very straightforward. You have to make sure you're accessing the deal flow that they're looking at. And our job is really to get market share and apply credit selection. On the non-sponsored side, you're typically dealing with counterparties who may only borrow money once in a decade, once every 15 years, once in a lifetime. And so to access that deal flow, instead of speaking to 20 or 30 counterparties, you're having to speak to hundreds of intermediaries to find that deal flow. So that's number one. Number two is underwriting or due diligence. Again, when you're lending to private equity firms, you're typically consuming the diligence that's been carried out by that private equity firm. When you're lending to non-sponsored borrowers, we're often carrying out that diligence ourselves. So we're hiring the accountants, the law firms, the consultants, whoever it may be. And again, that requires a team that has that skill set, that background, that understanding to do the work. And again, it's more work intensive. Then the last piece is asset management. When you're dealing with non-sponsored borrowers, they want a partnership. They want you involved in their business. They may want you on the board, but they certainly want that ongoing dialogue, communication, access to the platform and the resources that we can provide them with a platform like Carlyle. And again, that requires more time and effort. So each of those aspects mean that it's a much harder market to access.
Yeah, it's definitely much more resource intensive than investing in the normal credit markets. If you're willing to put in all that extra work, what are some of the benefits you get from doing non-sponsored lending?
Simplistically, it comes down to, if you take each of those aspects, those barriers to entry, it means the market is less competitive, right? And that relative lack of competition translates, generally speaking, into better economics and better structural terms, and overall better relative value versus other forms of credit or other forms of lending.
Taj, can you talk a little bit about Carlyle's investment philosophy in private credit?
Sure. Really, we position ourselves as being a partner of choice. So, what do I mean by that is we want to be the solutions provider and the people or the counterparty that people call when they have a need for capital. In terms of what we focus on in our philosophy, if you like, from a pure investment standpoint, our focus is good businesses, right? We want to focus on good performing businesses that sometimes have complex financing needs, sometimes have more straightforward financing needs, but really working across that spectrum.
So from the investor side, what types of investors in Europe should be looking to gain exposure to this space as part of their portfolio?
Yeah, look, private credit historically has been an institutional asset class. It's really been an asset class which has only been available to those large-scale, sophisticated investors. Very stable, predictable cash income yield at a clear premium to what can be achieved in more traditional liquid capital markets. As the market's developed and it becomes more sophisticated, we're now seeing other channels open. So an ability for retail investors to invest, or high net worth platforms or individuals to invest in the asset class. And we'd expect that to continue to grow. And the reason that the appeal for that investor base is exactly the same as it is for the institutional investor. It's getting access to that predictable income, cash yield, and again, with that clear return premium.
Taj, thanks so much for sharing your insights today. Thanks to all of you for tuning in to Insights from the PM's Desk, and we'll see you next time.